Welcome to the BankTalk podcast, the show where we talk to leaders and experts from the community banking sector. Whether you are a current CEO or aspire to be one, this podcast will give you valuable insights and advice on how to run your financial institution better. Each episode explores a new topic with a guest who brings their unique experience and knowledge. Tune in and discover something new each time you listen.
Hello, welcome to Bank Talk. I'm Rich Carty, sales executive with Remedy Consulting. Today we have a great episode lined up with Dr. Joe Berquist. He worked in banking for over 25 years, hosts a podcast called The Banker Next Door that I was able to join a few weeks ago. And we're happy to have him on today to talk a little bit about a report that came out through the FDIC on NDFIs, so non-depository financial institutions, and the impacts and things to think about, and really just talking through the growth of this subject. We're lucky to have him. Joe, thanks for joining us today.
Oh, hey, thank you so much, Rich. It's great to be here on your guys' podcast. I thank you. As you had mentioned, you guys were kind enough to come on and do my podcast a few weeks ago, and now I'm really happy to be on here with you today.
Absolutely. And thanks for being here. I know you're busy. What are you guys at? You've had quite I think 300 plus, if not more at this point, right?
As far as like episodes, like number of episodes?
Yeah.
Oh, yeah. I'm probably pushing up towards, I'm not exactly sure, but it's over 700 at this point. Yeah. I mean,
Okay.
But I would tell people a lot of the episodes are short though. Most of the episodes fall between 10 and 20 minutes in length. So they're short episodes. It's not like 3 hours or anything like that.
Well, I think a lot of our audience understands that they don't want to be on a podcast for too long. So we'll try to keep it to maybe 20, 30 minutes today. But thanks again for joining us.
Yeah, no, absolutely. And I'm really excited about this report here that we're going to talk about because I'm hoping that people will find this very interesting and will hopefully get a better idea of maybe some of the different ins and outs of the private credit world, so to speak.
Yeah. And let's maybe just start there. Let's spend a few minutes kind of starting with maybe the beginning of NDFIs, kind of their growth, if you want to start 101 per se.
Absolutely. So I'm going to jump ahead in the report here just a touch. So there is a chart on, and so the report that we're looking at here is from the FDIC, and this report is titled "Bank Lending to Non-Depository Financial Institutions." This was released in February of 2026, so just a couple months ago this was released. Now I'm going down to chart number 2 here, and it says loans to NDFIs grew significantly from 2010 to 2025. So basically, going back to 2010, right after the financial crisis, the NDFI market was this tiny little market, not really a whole lot going on. But then with the Federal Reserve making the changes that they did after the financial crisis, in other words, the massive amount of quantitative easing and also ZIRP, the zero interest rate policy, it forced companies, particularly hedge funds, private equity funds, they had to do what's called reaching for yield. And as a result of that, it really opened the door for them to lend money to other companies, other entities. And also, of course, new regulation, the Dodd-Frank Act, a number of different capital and regulatory changes that happened after the financial crisis kind of handcuffed banks in a certain respect. So there were certain types of lending that banks, particularly big banks, weren't as attractive at that point, or didn't really want to get into because they didn't want to run afoul of what the regulators were asking them to do. So those were the ingredients, if you will, to helping to grow this NDFI market. Now, what are NDFIs? So if I can give a couple of it, you have a couple different segments to this. So you basically have mortgage credit intermediaries. Now, what would that be? So I'll use Rocket Mortgage. So think of Rocket. So Rocket Mortgage comes to JP Morgan and they say, hey, JP Morgan, we have to fund all of our mortgages that we're making to our customers, but we need a warehouse line of credit to do that. We need say a $200 million line of credit. So that's what that is. That is JP Morgan lending $200 million to Rocket Mortgage, and then Rocket Mortgage lends all that money out. They lend all that money to all of their customers on a whole bunch of residential mortgages, and then they sell those mortgages into the secondary market and thus pay back the line of credit, and then the cycle continues to go from there. So, but then you have the other big chunk here would be business credit intermediaries. And that could be a number of different things. That could be different companies. That could be hedge funds. That could take the shape of a number of different entities. It could also become what is known as BDCs, business development companies. And then you have like consumer credit, which could be credit cards. It could be lending to like a hedge fund like Ares that then buys up consumer loans. Then
Okay.
you have another big chunk would be private equity. And then another chunk would be just classified as other NDFIs, which could just be other things, other type of lending that's out there. So hopefully that gives everybody a little bit of flavor there for when we talk about this, what this necessarily is when we talk about the non-depository financial institutions. And these companies are just that. These are companies that say, again, I'll use the example of a hedge fund. So, and unfortunately, I'll pick on Blue Owl because Blue Owl's been the easy
Yeah.
target here. But okay, so J.P. Morgan get $500 million to Blue Owl, and then Blue Owl then takes that money and they go and they lend that out to a bunch of different. They lend it out to 200 different companies, right? So again, Blue Owl is a hedge fund. They are not taking deposits, thus meeting the definition of a non-depository fund, but they're still a financial institution.
Right.
So thus the non-depository end of it. And then if I can for just a second, Rich, I just want to say something. So a lot of people kind of confuse, I think, the private credit market. The private credit market is a very big, complicated market, and it's not just one thing. Like a lot of people, I think, have a tendency to say, oh, well, NDFIs, that's all private credit, or that is what the private credit market is made up of. And that's not necessarily the case. Like the private credit could be money that's sold in and out, or loans that are sold in and out of banks. Like you have what's called SRTs, strategic risk transfers, where a bank will sell loans to try to get some loans off their books or spread credit risk. And that could be considered part of the private credit market. They could be selling those loans to a hedge fund or a private equity fund or somebody like that. So
Yeah.
so I just say that just to give people a little context to say, don't make it as simple as, oh, NDFIs equal private credit, because that is true, but it's just not the whole picture. Like there's a lot more going on there. And now we're also finding out more recently that insurance companies are playing a huge role in the private credit market with the money. I mean, basically insurance companies, I was just looking at some articles in the Wall Street Journal the last few weeks, and insurance companies are into the private credit market to the tune of over $1 trillion, which is pretty wild. So
Okay.
again, there's a lot of facets to this is all I'm trying to hopefully make
Yeah.
clear to the viewers.
Yeah, absolutely. And you talk about the growth. Obviously, there's been significant growth. A majority is with some of the larger banks. But maybe talk a little bit about the pandemic and how that helped with the growth aspect, and maybe anything else that's kind of allowing that to be supercharged growth per se.
Correct. Okay. So, and again, I'm going to go back to this chart number 2 here in the paper, because as you can see, if somebody is looking at this chart, you could see that the growth is nice from 2010 to 2020. The growth it's a nice, it's kind of steady growth. It's going up. It's 200 billion, 400 billion, 600, 800 billion. But right at 2020, when the pandemic hits, and now you've got the Federal Reserve pumping money in, the government pumping money in, and now this market at that point just really absolutely explodes. And then around 2024, you see another kind of explosion in growth where it really takes this up into the $1 trillion market stratosphere now. And you can see here by going up to the first chart number 1, we could see that basically the number one growth category for bank loans the last couple years has been lending to NDFIs. And it's the number one category by far. Like it's not even close. Lending to NDFIs makes up about 23% of the compound annual growth for the biggest banks in the country the last, like I said, 2 years, like 24, 25. The next category is multifamily, which is about 7%.
Yeah.
So this has really, in the last 5 or 6 years, really turned into a giant moneymaker for basically the biggest banks, the top 10, top 12 banks in the country. Now, why? Like, you have to ask yourself, why is that? And so I think the best way I could describe that is think of NDFIs as like, and this is kind of crude, but think of it like it's like a beast, right? Like, you've created this beast, and now you have to keep feeding the beast, right? You've got to keep feeding it. You can't stop. And the appetite in the NDFI market in a certain regards is almost like insatiable. Like, you've created this machine, and now you got to keep the machine going, and you got to keep feeding it. So they are constantly coming back. All right, more money, more money. We got to make more loans. We got to make more loans because you got to keep this thing churning. And so, like I said, so we've hit these levels right after that infusion of money from the pandemic funding just turbocharged this market. Now all of a sudden it was like sky's the limit. Okay, now we're just you can't get the money out the door fast enough. And so hopefully that helps to kind of explain how this has grown as quickly as it has in the last
Yeah.
few years, and why it's so important to the biggest banks, because the last couple of years this is their number one growth and lending category. So, not that it may be as extreme as you don't want to kill the golden goose, but I don't think we're far from that. Everybody's looking at it and going, okay, what do we do? If we dramatically slow down NDFI, then what does that leave us with as far as our growing our revenues and everything for the year? So I think that's the big concern right now amongst a lot of the biggest banks, if you will.
Yeah, like you said, majority of I think you said top 10, I read in the report, over 70% of them are 10 of the largest banks in the US. And I guess on the flip side of that, and maybe putting you on the spot, have you heard or read anything, because they are risky, like you said, once they are in place, you don't know on the other side of it. Is there anything that would curtail that, or that the risk would become so much that it does slow down the growth? Like, you know what I mean?
Yeah, I think unfortunately this is a case where I think the regulators are going to have to come in and basically slow this down. I just think that, and what's going to happen is, and I don't have the information in front of me, but I saw something this morning that I didn't get a chance to look into, but it looked like there was a couple more defaults in some way, shape, or form in the private credit market that were now bringing further concern to the table. But again, to go back to the primary cases, like you go back last year, in September, October, and you look at the basically blow-ups of First Brands and Tricolor Holdings and a company called PrimaLend. And then there was another mortgage lender over in the UK, I think called MFS,
Okay.
that basically blew up. And so you look at this and you begin to ask this question of what a couple things we'll get into. Number one is the underwriting. Like, okay, are they really underwriting bad loans, or are they blind to the second level of underwrite of loans that are being made here? And let's table that for just a second. The other thing we'll probably get to eventually here to the end is that regulators already have changed the call reports for, like, at the end. I'm going to bring some up here. So starting in December 31st of 2024, call report filing. So US banking regulators now require banks with total assets exceeding 10 billion to disaggregate loans to NDFIs into 5 specific subcategories, including reporting unused commitments. So that is a positive thing. And now in the last 4 or 5 call reports, the quarterly call reports, we have at least been getting somewhat updated information on what the exposure is to some of the big banks. So that's a start. But I do think that the regulators are really going to have to kind of hone in on this and basically say, wait a minute, again, not like totally put the brakes on, but they're going to have to perhaps dig in and say, hey, you know what, we really need to make sure that we've got our arms around this, and that we really understand what's going on here, so that this does not become a systemic issue. And one of the things that we just saw in the earnings reports for the first quarter that came out, was that we saw this pattern amongst all the CEOs of the bigger banks really downplaying the risks to the private credit market. And it's like, okay, you could downplay the risks, that's fine. But this idea that it's not systemic, I would challenge that, because, and I could give you a scenario there, Rich. Say Blue Owl goes under, right? Now, Blue Owl, they come to the Fed, they knock on the door, and they say, "Hey, Mr. Federal Reserve, we're about to go under, and I think you need to bail us out." Now, the Fed goes, "Well, wait a minute, hang on, you're not a bank, so we can't just arbitrarily bail you out. We don't necessarily have the ability to do that." And then Blue Owl says, "Well, okay, that's fine, but yeah, I'm just telling you that, we have all these loans to JP Morgan and all these other banks, and when these loans go bad, and we pack up shop, that's going to be left to them. They're going to take major hits, and this might cause one or two of those banks to have a big problem. Furthermore, we're also co-lenders and maybe commingled borrowing with about 3 or 4 other hedge funds, and there's a chance that this could bring down those other hedge funds. So it's not just me calling; it's actually these 4 other hedge funds are going to be calling you at the same time, because the dominoes are just going to fall and go do 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 do. So I could see something like that happening, and who knows? I mean, you've got KKR, Apollo, Blackstone. I mean, you've got the biggest players in private equity right now. I mean, their stocks are down 20%, 30%, almost 40% in some cases with Blue Owl. So I mean, that's not an insignificant downturn in their stock, you know. So all I'm saying is it wouldn't shock me if one day the hedge fund comes to knock on the door of the Fed and says, "Hey, we need some serious help here. And if you don't want to help us, then that's fine, but then it could lead to these ripple effects, which will cause you problems and will become more systemic in nature." And then you're faced with probably much smaller, but you're almost faced with a quasi Lehman Brothers moment of, hey, do we think of moral hazard and do we let these guys go? Or do we need to do something to kind of put a pin in this and stop it? So it gets to some really interesting questions. But to get back to your original question, Rich, and that is regulators are already starting to really look into. I mean, you're already seeing action from the SEC, from the FDIC, from the OCC in terms of really starting to take a deeper look at these NDFI holdings by bigger banks. I mean, so that's already started. That process has already started. They're already starting to look in and ask questions and basically say, "Hey, can we get some more information on this? Because we need a better understanding of what's going on here." And so, but I would also say, I think that bad things have to continue to happen. I think for the regulators to really step in and really put the brakes on this. I think as it stands right this moment, I don't know that they will necessarily do a whole lot. Damage hasn't been to the degree or of the level of them like hitting the panic button, so to speak. But it's tough to say how far we are away. Like, in other words, how many more companies have to blow up, or how many more losses do bigger banks have to take before they start to jump on them a little bit more, so to speak.
Yeah.
That I think that's the $1 million question, if you will.
No, I think it's a good insight to hear from you. And like you said, feed the beast, continue to let it go and see where it goes, hopefully. And again, we've said it, major concentrations with the largest banks. Community banks, I think they've grown, say, 1% to 6, I think, maybe looking at it over that same time frame of the growth. So there is
Yep.
growth there. Do we know which community banks are kind of looking into this? And is there a certain size that you think that are doing well with it? Or do you have that info?
That is a great question. I do not, unfortunately, have that exact info. I could not tell you off the top of my head if there are like some good examples of some community banks that
Right.
are perhaps deeper into this than others. There are some regional banks. There are those banks in that 10 to 100 billion range. There, like Zion's is a great example. Like Zion's took some hits from, I think, First Brands. Western Alliance might fall into that category. So there are definitely some regional banks that are in this discussion or in this conversation. Absolutely. So I think you could definitely look at some of them and probably want to look very closely about what's going on and what they're doing, because, yeah, they have definitely had at least a few issues that have popped up.
Okay. And I know in preparation to our podcast today, we were talking about this specific report, but I know you had mentioned a couple other places to maybe read about or learn for our listeners if you wanted to share those.
Yes, yeah, absolutely. So I would say like I have a couple of S&P Global articles that I wanted to share real quick. So the first one was that basically this is from April 9th. of this year, so just a couple weeks ago, that was basically big banks dominate NDFI lending as industry interest and regulatory concern grows. And this is just an article that just reinforced what we were just talking about how, yeah, regulators are really starting to look into this and are really starting to take notice of what's going on here and the concentration in the biggest banks and how your top 10, 12 of the largest banks in the country really have the large exposure to this NDFI lending market, if you will.
Yep.
And then the other one was from February 26th, and that is U.S. banks' NDFI lending pace reaccelerates in the fourth quarter of 2025. So what happened was in September and October of last year, when, as I said earlier, when we had these blowups with First Brands and Tricolor Holdings, banks they did actually put the brakes on a little bit and they slowed down lending to NDFIs in the third quarter of 2025. But then, as this article basically says, they immediately reaccelerated in the fourth quarter right back to normal. And that gets back to the other aspects of what we were talking about a few minutes ago of you got to feed the machine, you got to feed the beast. Like, this is not something that I don't know that any party to it, and the NDFIs, the big banks, I don't know that anybody really wants to slow this down or turn it off, so to speak, at the moment.
Yep. Okay. In the report, they touch upon 5 subcategories and kind of break those borrowers down. Maybe we go through that a little bit.
We'll be right back.
Ever feel like your tech budget's running the show instead of supporting it? You're not alone. Between bloated vendor contracts and outdated systems, a lot of banks are stuck paying more for less. And here's the kicker. Those big tech vendors, their contracts are built to protect them, not you. So if you're hesitating to make bold moves because of tech costs, it's time to flip the script. That's where Remedy Consulting comes in. We help banks take back control, cutting through the fine print, optimizing spend, and finding tech solutions that actually fuel growth. And we're offering a free review of your tech stack, spending, and vendor contracts. No pressure, no sales pitch, just expert insight to help you make smarter decisions. Even if we're not the right fit, you'll walk away with clarity and confidence. So go to remedyconsult.net or call 206-295-5776. Let's make your tech work for you, not against you. Thanks for listening to the BankTalk podcast.
Yes. Okay. So the 5 NDFI subcategories are loans to, number 1, mortgage credit intermediaries. Number 2 is loans to business credit intermediaries. Number 3 is loans to consumer credit intermediaries. Number 4 is loans to private equity funds. And then number 5 is other loans to NDFIs. So, and if I could, I guess, just give a little brief touch on each one here for just a minute. So,
yeah, please.
Mortgage credit intermediaries are companies that specialize in residential or commercial mortgage origination, servicing, or securitization activities. Business credit intermediaries include SPEs, finance companies, direct lenders, CDOs, CLOs, private debt funds, leasing companies, ABCP conduits, business development companies, BDCs, small business investment companies, SBICs, or other intermediaries with more than 50% of assets or lending activities being loans to businesses. So this whole private credit and lending to NDFIs, it is a big market. It's not a little thing with like just one or two little players in here. You got a smorgasbord of all different types of companies here. Number 3, consumer credit intermediaries, again, are SPEs, finance companies, direct lenders, private debt funds, leasing companies. Number 4, private equity funds are investment vehicles in which investors pool funds to invest in the equity of private firms. And then number 5, other loans to NDFIs are loans to NDFIs that are not already defined in the other 4 NDFI subcategories. This subcategory includes loans to holding companies of other depository institutions, insurance companies, federally sponsored lending agencies, and loans to investment banks and broker dealers. So I think part of the problem here And again, it goes back to the question, Rich, of underwriting. So, I'll pick on J.P. Morgan again for a sec. So J.P. Morgan lends money to this XYZ hedge fund over here. Was the underwriting of XYZ hedge fund inappropriate or bad or not sufficiently done? No, I don't think so. I think they probably followed their normal underwriting process and underwrote it, and everything looked good, everything looked fine, and they signed off on it, and so everything was as it should be. The problem is XYZ hedge fund then goes lends that money to all these different, they lend it to pension funds and endowments and sovereign wealth funds, everything. And the problem is the bank is blind to the underwriting at the second level there. That second level of lending from the hedge fund now out to all of these different types of entities. That's what they're blind to, and that's what they can't really quantify, and therein lies your problem, where the bank has this blind spot of not really being able to say, "Well, we think that XYZ hedge fund is okay," but they can't. I don't know that they can 100% be sure of that because they have to rely on the financials and the reporting from that hedge fund. For example, one of the issues with private equity is this notion of them inflating the values of their net assets. And
Yep.
that's again, it gets to like the underlying issue here of it's kind of like do you don't know what you don't know kind of thing.
I hear you. I can see the risk side of it, but we'll see how it all transpires, or if anything goes wrong with any of them moving forward, I guess.
I think hopefully your listeners would agree. I mean, my hope here and you and I talking about this, Rich, is to just try to give people some more context and understanding around this issue, around the type of lending here. And I hope one of the takeaways that people have here is that it's complicated. This is not a simple thing to delve into and understand. Like there's a lot of different facets and moving parts to this whole thing. And I think that's what makes it difficult. And that's why I find it interesting when just some of the bank CEOs and other executives and people out there and people on CNBC or Bloomberg, whatever, they're somewhat dismissive of this. Like, oh, well, yeah, well, that was just a one-off, or that was just one product. It's not to worry about. And I say, well, yeah, I don't really know about that because it's from what I have studied and what I have read and reviewed here. It's complex. It's very complex, and it's not. I don't think that this can be easily dismissed as like, oh yeah, there's no big to do here. I think it's more complicated than that.
Yeah. Well, what else? Is there anything I missed, or anything else you think that's worth bringing up from some of these writings that you've been going through?
Around the NDFIs, no, I think we kind of hit. And that's why I thought this report in particular was so good because it's only like a 10-page report, but it really gives everybody a great overview of what's going on. Talking about the call reports, talking about the different segments of NDFI, talking about the concentration of NDFI, showing about the growth in the NDFI market over the last 15 years. The FDIC really did a really nice job of putting together a very short, concise report that gave everybody the nuts and bolts of what's going on here with NDFI. So I think that's the real takeaway. This report is free. It's available to the public. All you got to do is go out and Google it and you can find it. So like I said, hopefully some people will go and check this out when they have a minute.
Okay. Well, I'm going to steal a page from your book because I know when I was on, you asked me about favorite movies and things like that. But I know you're a big movie guy. Any good movies recently that you've seen that might tie into banking that would be good for the audience?
Two great movies that I saw last year. One was called Dumb Money. If you've ever heard, that was all about like the stunk stocks and GameStop and all that. Tremendously funny movie, great cast, well written, well acted. So if anybody has a chance, go out and watch Dumb Money. That was great. And then there was also the BlackBerry movie,
Yeah.
which I think might have just been called BlackBerry.
I think you're right. I think I ended up watching that on a plane on a trip. But I would agree that was pretty good.
Yeah, that movie also they're both movies are kind of along the same vein. They're a lot of comedy, very funny. It's kind of like the hijinks of it, but real life stories with based on real people. and things that actually happened. And they're both very entertaining movies that tell a great story. And particularly with BlackBerry, I think if you were kind of in corporate America there in the
Right.
early 2000s and you kind of
Right.
lived through that, you will absolutely laugh as you sit there and watch those movies. But I will always say, though, one of my all-time favorites is Wall Street. I always go back to Wall Street with Michael Douglas because I remember watching that, being about like 10 years old and watching that movie, and not that I understood it, but it captured my imagination. It captured the goings-ons in the business world and the trading scene on Wall Street. And from a very early age, I was kind of like, man, I'm into this. I love this. I'm fascinated by business, by the stock market, and by companies, and by, these guys trade stock. Like, what's that? What's that all about? And so that was the movie that really, like I said, really captured my imagination. And I think that movie's great because there are still probably 3 or 4 scenes in that movie that are still as relevant today as they were the day that was made back in the '80s. And I think that's why that movie endures as an all-time classic, just because there are just some really profound scenes in that movie that just really hit at business, the Wall Street culture, what the morals and ethics in operating in the business world, if you will. So, again, I always go back to that.
Awesome. Yeah, and it's good to hear that. For everyone out there, thanks for listening today. You can find Joe's podcast, thebankernextdoor.com. He's got some great episodes out there, and we were lucky to have you today, Joe, to kind of dive into the NDFIs side, and hopefully we can have you on again once we get through a few more episodes and find something else that's relevant that you can bring up.
Yeah, no, absolutely. Thank you so much for having me on, Rich. And like I said, if I could give a shameless plug real quick, everyone can go to my website at www.thebankernextdoor.com. You can find the podcast on YouTube, Rumble, and all major podcast platforms. But yeah, I had a great time on here, Rich, and would definitely love to come back again. Would certainly love for you to come back on my podcast at some point in the near future.
For sure. We appreciate it, Joe. Thanks for the time. And we'll catch you guys soon. Keep learning, keep listening. Thanks again.
Thank you so much, guys.
Thank you for joining us on the Bank Talk podcast, brought to you by Remedy Consulting. If you enjoyed today's conversation, please rate, review, and share our work with others. To stay up to date with future episodes, be sure to follow the show and turn on notifications. Thanks again, and we'll see you next time.